Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Okay, so as we said, trade definitely on the minds of investors. So too is next week's Fed meeting amid a Fed chair that is continuing to be in the crosshairs of President Trump. Let's get into today's macro, all that's coming at us, all that's coming at the Fed chair. We've got with us Bloomberg TV and Radio International Economics and Policy Correspondent Michael McKee. Mike, first of all, are we getting more certainty about the U.S. economic outlook because of what we're seeing in the data points, because we're starting to get movement on trade agreements? Any signs that things are settling into a clear economic trend here in the United States?
I hate to disappoint you, but no. We've had indications that we're getting some tariff pass-through into inflation from the CPI and PPI. Not a lot yet. But the biggest problem is Donald Trump's tariffs, for the most part, have not gone into effect. August 1st, in theory, is the deadline. We don't know if there'll be a taco on that, some sort of delay. He's suggesting that could happen if they're negotiating with the European Union at that time. But if and when the tariffs do come in, it's obviously going to put pressure on companies and company margins. And so we will then start to see who passes through, how much, and what kind of impact on inflation and consumer psychology there is from all this.
The president earlier today, Mike, was asked about the money that the U.S. has brought in or is bringing in when it comes to tariffs. He was asked by reporters before he made his way to Scotland. And he did say that we could use the tariff money for rebates to Americans. Help me out with that from the perspective of something inflationary, but also less on the inflation side and more on how much money has the U.S. brought in when it comes to tariffs?
They brought in about $100 billion so far, but bringing in the money is kind of a misnomer. I mean, somebody's got to pay that, right? We're not printing money here. This is not coming as a gift from the clouds, nor are the foreign countries paying it. Some of the costs may be absorbed by foreign companies, foreign exporters lowering prices. But most of this is at the moment either coming out of consumers' pockets or coming out of corporate pockets, say compression of margins. Now, that still means that somebody's paying it because that comes then out of shareholders' pockets. Mm-hmm. So there is an effect on the economy. We just haven't seen a huge impact yet because there haven't been a huge amount of tariffs in place. But we are seeing higher prices for cars. We are seeing higher prices for appliances, things made out of steel. So we are going to have an effect. The question is how much and who's going to directly affect, whether he gives people money back or not. That seems like a weird idea to me because he's campaigned so much and people have campaigned so much on the deficit. Mm-hmm. And he's argued that his big, beautiful plan is not going to increase the deficit. Well, if I get some revenue that is supposed to offset the deficit and then I start handing it out to people, I'm not going to reduce the deficit.
All right. Really good to keep kind of all of these things in mind. One of the things I'm thinking, too, though, is about the trade deals yet to come, China, EU. These are some of the big ones.
Right. And the question is, what are these deals actually going to be? So far, we don't have any signed actual point-by-point agreements. The British are still working out the details with the United States. And so you can imagine for China, it's going to be very complicated. For Japan, it's going to be very complicated. And then the most complicated of all is going to be the EU, because the EU, while it negotiates as a bloc on trade, is 29 different countries, and some of them aren't going to like parts of this.
Mm-hmm. The president also today saying that on trade deals, most of the deals are letters instructing tariff rates. So those letters we got a couple of weeks ago that say 10 to 15% tariff rate, some higher, some lower, depending on your country of choice. He's calling those deals.
He's calling those deals because he's trying to make this all look good. And to the extent that he's allowed to put tariffs on, and that's an open legal question. And next week on August 1st, they're also hearing this case at the appeals court on whether or not he can impose the tariffs under the International Economic Emergency Act that he has cited. If he can't, then all of this falls apart. If he can, then the question is, how legal are these agreements in terms of both sides living up to them? He made a deal with China, in theory, in the first term, which they didn't live up to. And any kind of real trade agreement has to be ratified by Congress. So, we don't quite know where this is all going to end up. And this is just sort of the ongoing chaos that we have been seeing.
Mike, the assumption that we're going to have all this investment going on in the United States, building of factories, manufacturing happening here. I keep going back to this quote from a story I read, I think it was on Monday. And this was a senior economist for emerging Asia at Natixis. The individual said at a 15 to 20% tariff level, it's still profitable for U.S. companies to import from abroad rather than produce similar goods at home. So she said this in a Bloomberg story. So if we are thinking that there's going to be a lot of economic momentum out of all of this investment, that's not something we should assume, or I don't know. How do you...
No, you can't assume it. And it's one of the interesting things about the Japan deal is they said they were going to invest $550 billion. Well, is that $550 billion new dollars over what period? Or does this include factories that are already under construction? It's really hard to tell what any of this means. There was a lot of money lined up to build factories under the Inflation Reduction Act, the kind of misnamed one from Joe Biden. And are they counting that? We just don't know, and we don't know whether companies are going to follow through. We've had a lot of cases where we've seen promises made that were not kept in the long run. So it's all kind of amorphous at this point. The only thing we know for sure is if the tariffs do go on, we will see inflation, even if we don't know how much.
You weren't here with us yesterday.
I'm sorry. I apologize.
We could have used you. I wanted to get your reaction to what happened at the Federal Reserve yesterday afternoon, the back and forth between the president and the Fed chair, the tensions kind of actually seeming to dissipate a little bit.
Yeah, I think both sides kind of wanted that. As I've been saying on this program for a long time, and now I'm copying on other programs, Trump is a master of the squirrel. And he's been using these Fed attacks lately to distract from Epstein, and that's pretty obvious. But also, he set up a fall guy. If we do get a lot of inflation, or if we do see the economy start to weaken, then it's Jay Powell's fault. It's definitely not going to be President Trump's fault, according to President Trump. So you've got that going on. But then you had the president after yesterday's meeting saying it was an honor to go to the Fed, and the Fed today saying it was an honor to host the president. I think both sides want to back off a little bit from this. Trump's decided probably not worth it to try to fire him and go through all that. And the Fed's going to just say, we're going to do our job and stick to our knitting. We'll still get a tweet on Wednesday or Thursday after the Fed decision and they don't cut rates, but I don't think we have to take it too seriously anymore.
All right. That's good to know, but certainly keeps us on our toes. Mike, thank you. Have a great weekend. Bloomberg TV and radio, international economics and policy correspondent, our own Michael McKee.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, now we want to get back to talking a little bit about the Fed. That has certainly been top of mind, I want to say, over the past week or two, easily, and certainly in the last 24 hours.
Yeah, as we saw with President Trump yesterday, whose unprecedented walkthrough at the Fed's now controversial building renovation project with Fed Chair Jay Powell ultimately ended with a sign of relief for the Fed chair, who's been under pressure for months to slash interest rates.
I have one dispute, and the dispute is there could be some things with money and, where it comes from, how it's come from, how it's printed, where it's printed, all of the standard things with the Fed. But I just want to see one thing happen. Very simple. Interest rates have to come down. I just don't think it's necessary. And I believe that he's going to do the right thing. I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing.
That's President Trump yesterday after he toured the construction project at the Fed with Fed Chair Jay Powell. Amid the continued presidential criticism of the Fed chair, we continue to wonder in these unprecedented times whether or not legally the president can actually get rid of the Fed head. With us is Catherine Judge, Harvey J. Goldschmidt Professor of Law at Columbia Law School, also the author of Direct, The Rise of the Middleman Economy and the Power of Going to the Source. Her research focuses on banking, financial crises, regulatory architecture, and intermediation design beyond finance. She joins us from New Jersey. Professor Judge, simple question. Can the president fire Fed Chair Jay Powell?
Not based on what we've seen so far. He does have the ability, if there's causal reason to fire Jay Powell, to fire Jay Powell. But I think what yesterday's visit made clear is he's nowhere close to satisfying that legal standard. The very fact that we saw him try to trump up an inflated cost estimate based on trying to bring in a third building was in many ways a concession by the president that he really didn't have the case that he needed for removal. So I think right now, Powell and the Fed should feel very good.
All right. So maybe he can't fire Fed Chair Jay Powell, but he can still do some damage, right, by the constant criticism?
He can do damage. He can do damage. And I really, what's hard there is it's damage not just to Powell, it's damage to the Federal Reserve as an institution. And I would actually say a lot of damage has been done and more is likely to still come. I mean, one of the challenges is that right now, the markets really trust Jay Powell, and for a very good reason. He has been an incredible Fed chair. He's been clear about what he's trying to achieve and how he plans to achieve it. And both during President Trump's first term and during this term, when he has faced pressure that he feels like is not warranted given kind of economic conditions, he is focused on serving the long-term aims of, keeping inflation in check while also promoting employment. And so the real challenge that the president is creating is he's creating an environment where it's going to be very hard for the next Fed chair to come in and build up that same type of credibility.
Yeah, talk a little bit about that and the potential response. And I know you focus on this from the law perspective, but what would that mean if the Fed chair doesn't necessarily have credibility, the next Fed chair?
It could mean a lot of different things. I mean, so first, one of the challenges is that the president wants lower rates. A Fed chair can't necessarily deliver lower rates. A Fed chair is one vote of 12 votes on the Federal Open Market Committee, the FOMC, that determines monetary policy. So one of the first challenges that a new Fed chair is going to face is how to get 7 votes, how to get the support that he needs in order to drive through the agenda that it seems like the president clearly wants to see. Longer term, the challenge is not just to the president, but to the country. I mean, at this point, we have an incredible deficit. One of the easiest ways for any country to reduce the effective burden of its deficit is just to inflate it away. And so our creditors are going to be looking very carefully at whether or not we're willing to maintain a central bank that has the independence needed to be able to assure creditors that we're not going to try to use that technique. And I think without that credibility, there's going to be significant costs in terms of financing.
Professor Judge, one last question. We are next talking with Rob Kaplan. He's former president of the Dallas Fed. Curious what you might ask him when it comes to Jay Powell and that presidential pressure and anything else related to the Fed.
Yeah, I mean, actually, I think Kaplan's a wonderful person to talk to because the reserve banks are an underappreciated element of how the Fed has stayed independent. I mean, if you actually go back to the 1935 Act, a lot of the question was how much power are we going to give to the board in the centralized position? How much presidential influence is there going to be over the board? And how much are we actually going to reduce the capacity of any administration to shape policy by putting meaningful authority in the hands of the 12 reserve banks across the country, which again have 5 of the 12 seats on the FOMC. So I think one of the things to really focus on with Kaplan and that we should be looking at generally is when are the threats going beyond the chair? Because we've seen tussles between presidents and chairs in the past. And when might the president take steps that really endanger or threaten the broader institution, including the reserve banks?
All right. You're a gem, and you set us up so well. I'm so glad we could get some time with you. Catherine Judge, she's Harvey J. Goldschmidt, professor of law at Columbia Law School, author of Direct, The Rise of the Middleman Economy and the Power of Going to the Source.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It's not just buyout firms that want a slice of the $12 trillion pool of retirement savings in 401k and other defined contribution plans. Their private credit brethren want in too.
I bet they do. Yeah. So when word spread last week that President Trump is keen to spur more private assets into retirement funds, the biggest direct lenders, Tim, were more than prepared. I mean, this has been, I feel like, in the works, a lot of conversations over the last couple of years.
I mean, how could they not want it?
Yeah. Everybody's been talking about
It's an opportunity for money to go into these funds. So we're talking KKR, Blackstone, Blue Owl, already set up partnerships with 401k managers. Trade groups and industry executives have also been lobbying officials in Washington and making their case to the public. It's all part of a long-running effort to expand private credit's reach. Back with us for a check on this and more when it comes to private credit is Christina Paget, Associate Managing Director, Head of Leverage Finance Research and Analytics over at Moody's. She joins us from the Catskills. From your perch at Moody's, where you look at research when it comes to leverage finance and analytics, how do you look at the possibility of private credit becoming available to 401k and other defined contribution plans? What would that do?
Well, it depends how it's done, right? And so from the perspective of the retail investor, you want to make sure that there's broader reporting, that there's more transparency, some of the things that haven't been necessarily incredibly consistent with the way private credit operates. So private credit will probably have to change somewhat if it becomes more available to a retail investor. Some of the other concerns that we have are on the other side of the coin, where if you actually get all this additional capital, do you have sufficient assets to apply that capital to in the right time horizon? So there's finding the right assets, and then there is educating the new consumer of private credit, the retail investor, which tends to be a much less sophisticated investor and one that has different needs than an institutional investor, particularly insurance, right? There's a big difference between an insurance company that's a long-term investor and a retail investor that thinks retirement, but then has other events in their life that may interfere with that goal.
I'm getting some very heated instant messages, IBs, on the Bloomberg terminal from a listener viewer right now about this. He argues that it's terrible for 401ks, and he says he's curious why you think private credit is so excited to get retail involved.
I would say it's pretty clear why private credit would be interested. They have been seen as sort of a slowdown in their ability to raise capital on the institutional side. They're growing bigger all the time. They see opportunities. So this is another, for lack of a better word, bundle of cash to invest. And if you think for a moment about why there's this need for capital, there are some tailwinds to the industry, meaning that both Europe and the US is looking to grow capital formation. There's deglobalization, which actually encourages some onshoring and investing in onshoring. And then in Europe, you'll have additional defense spending. So there are reasons why there's additional capital that needs to be deployed. The difference is how private credit operates for institutional investors versus how they might operate within a 401k kind of dynamic.
And not only how they operate, but also what private credit products become available to that. I'll just go ahead and say it, like a less sophisticated audience, group of people, a clientele. Like how do you protect that mom and pop investor who's trying to save for retirement from something that might not necessarily be, as I guess a financial advisor might say, prudent as a low-cost index fund?
Well, certainly it may not be as conservative as a low index fund, and it will be more pricey probably, right? Your fees will be higher. The offer is that returns will be higher as well. The things that will have to change for this to sort of happen smoothly is that you will need to do a some more educating. And it doesn't mean that every 401k investor will be engaged with this, but you also will probably see changing in reporting requirements. Regulatory environment has been looser lately, but in general, we expect to see better reporting, more transparency when you offer something to the retail investor, and
right,
it's hard to judge that in advance. We haven't seen what that looks like.
Christina, what would you like to see? Moody's, right? Like your rating, you guys, have to determine the security, the risk aspects of various, financial instruments. So what do you need to see? What would you want to see to give it more transparency, and so that there are maybe some more assurances or insurances for retail investors, but at the same time, it's a different marketplace.
Yeah, and I don't really know that we're entirely sure how it will evolve. For example, one of the things that private credit experienced advantageously was the illiquidity of the product and the complexity, right? That gave them an opportunity for premiums, and some of those companies actually preferred to be in a private market. So those dynamics are going to inevitably have to change if it's an offer to a retail investor. So you might find something that's in between what we're looking at today. Maybe the returns won't be as high, and maybe the complexity won't be as significant, and maybe you'll be able to have clearer reporting guidelines. That being said, none of this has really emerged yet, so we are still watching it pretty closely. And from our perspective, one of our fundamental assessments of private credit that gives us concern is the opacity in the sector. So that's something, and also maybe, the fact that it hasn't been tested, but there are advantages to the sector, and that has been the patient capital story, right? You'd rather have long-term capital invested in some of these projects. If the 401k investor understands that this is a longer-term investment and that it isn't something that they can take in and out, it may work for them as well.
Yeah, no, I totally get that. Hey, one of the things, and I think about people who are listening, and forgive me, and this is with all due respect, but I mean, your credit rating agency, and we think about the financial crisis and things that were missed by the rating agencies. How do we ensure that you guys and everybody else get it right, if indeed there is more oversight, and that you are able to have some way of really tracking risk when it comes to private credit investments?
Well, I think we're doing our best to highlight the various concerns as we see them. We have insight into many of the institutions from different angles. So our team that is following the insurance companies, they can look at an insurance company, see their exposure to private credit alongside the asset management team that's looking at Apollo and what Apollo is actually doing. So we have ways of sort of triangulating, hopefully, what's going on in this market. And, I think everybody in this business is sensitive to reputation risk. That being said, being able to call the next bubble, that's not something that most of us are confident we're going to be able to do in advance, right?
It's interesting. And when you say that everybody has some responsibility, anytime we talk to anybody in the world of private credit, they basically say, hey, listen, if we're doing a bad job, we're not going to get funds, and we're not going to get, we can't raise another fund or get more money to invest. Having said that, our own Sonali Basak caught up with Harvey Schwartz, the chief executive of the Carlyle Group, and she asked him about, risk in the cycle. Do you worry maybe that this industry could fly away a little bit if there isn't a bigger set of eyes on it? And so he said, do I think we could have a bad credit cycle? Sure. The question is it systemic in that it actually triggers a broader crisis? Banks have failed, but we haven't seen credit funds fail. And I guess we would all add, yet. Is there an assumption on your part and your team's part that at some point there's going to be something where we see some problems, or not necessarily?
Well, I think it would be hard to imagine that we're not going to see future challenges in the space. You know, that if you think about the strategy here, they are adding leverage, right? And that makes businesses more fragile in a downturn. So the downturn can happen for any number of reasons, right? We've seen it as a consequence of a health crisis, meaning the pandemic, or, you know, more sort of financially oriented crises. One of the things that we thought was beneficial about private credit was that insurance companies, institutional investors, they tend to be more patient. And so that reduces the volatility during the period of a downturn. Some of this locked up capital is beneficial. And I think that's why perhaps your Bloomberg texter is saying this doesn't feel like that. And so that's something that we are watching quite closely, because asset liability mismatch is probably one of the major concerns that we have around this market as it evolves. It's actually been a benefit today.
Great to get some time with you. It's a space that we love talking about. We cover it. We keep increasing, I think, our coverage of the private markets here at Bloomberg, as kind of the rest of the world does as well. Christina, thank you so much. Christina Paget, she is Associate Managing Director, Head of Leverage Finance Research and Analytics at Moody's.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Well, shares of Alphabet are up for a second day following earnings late Wednesday. The company, as you know, said demand for AI products boosted quarterly sales and now requires an extreme increase in capital spending, heightening pressure on the company to justify the cost of keeping up in the AI race. That's kind of the big picture. Google Cloud revenue, and that's something we want to focus on, and operating income topped analyst projections. Our own Bloomberg Intelligence's Mandeep Singh writing after earnings that Google's increased CapEx view by $10 billion for the full year suggests that cloud segment growth is likely to remain above 30% through the second half. Well, our next guest is the Chief Operating Officer of Google Cloud. In fact, its first COO. Great to have with us is Francis D'Souza. He joins us from the Bloomberg News Bureau out in San Francisco. Francis, welcome. So nice to have you here with Tim and myself.
Great to be here. Thanks for having me.
I want to start with AI and cloud demand. As you know, it feels like so many conversations start with AI. AI contributions to Google Cloud growth, 32%. What are you seeing currently and continuously when it comes to AI and cloud demand?
Yeah, right now it feels like there are two powerful megatrends that are playing out in the enterprise market. The first is, the continued move by companies of their workloads to the cloud, of their applications to the cloud. And the second, much bigger trend that's playing out right now is the adoption of AI by companies. And those two powerful megatrends are driving our business and fueling the growth that you saw in the quarter. And so what we're seeing on the AI side is, this is the fastest in my career that I've seen a technology move from pilots to production. And so what we're in talking to customers, what they're telling us is they're recognizing the benefits that AI can bring into their company across the board. We have companies like Verizon that are using AI to help do customer support. We work with Seattle Children's Hospital that's using AI to inform physicians in their communications with patients. We also have companies like Papa John's or McDonald's that are using AI in the franchises. And so we're seeing broad adoption by enterprises across a number of places where they can see the benefits from AI.
You just mentioned a few examples of companies that you work with. There are a lot of small businesses, though, and even large businesses that I think it's fair to say haven't fully harnessed what you view as the opportunity when it comes to AI. How big of an opportunity is it for Google Cloud? What's a number? How can you quantify this?
Yeah, I think you're absolutely right in that we're the very early stages of what is a very large sort of adoption market in front of us. Now, you look at the numbers we delivered, last quarter in Google Cloud, we delivered $13.6 billion in revenue. And as you said, that's up 32% year over year. So although the numbers are already big, we're still just at the very, very beginning of AI adoption by companies. And that's true whether you look at small companies who are starting to use it in terms of their outreach to customers to scale up their presence from a marketing perspective, all the way to large enterprises. We're just at the very beginning of this big wave.
One of the things, Francis, and I'm so glad we could get some time with you, is that, everybody kind of throws out AI and large language models generally, and we're just trying to get more of an understanding of how this all impacts our world. Drill down a little bit further in terms of the customers that you are working with, big, medium, and small, and how they are using AI and how it's going to impact our lives.
Yeah, we are seeing it show up in enterprises in a whole bunch of different ways. And so let me give you some examples. Some large manufacturers like Toyota, for example, or Honeywell are using AI on the factory floor to provide information to the people working on the factory floor to improve their operational ability, and also to provide access for their customers to engineering and technical support documents around the product. So make it easier for customers to navigate and find the information they need. We're seeing some hospitals, as I talked about, using AI to help provide physicians access to whether it's guidelines or any background information. In addition, we're seeing hospitals use AI to automatically transcribe the communications with their patients. So what AI will do is actually take the notes automatically and then upload it into the systems that it needs to. What that does is it frees up time for the medical professionals to do what they do best, which is deal with patients. We're seeing small businesses that are using AI to create marketing materials and do that much more efficiently. We're seeing large retailers like Wayfair that are using AI to create more personalized experiences for their customers when you come to the website. So you can imagine, as you're using Wayfair, you can imagine how the furniture items will look in your environment, and that provides a better shopping experience for customers. So we're seeing a wide swath of ways that AI is being used in companies.
I'm so glad you mentioned kind of the medical area and what they're doing, because I think a lot of folks come on our air and talk to the Bloomberg audience and talk about how AI might significantly impact not just hospitals, but just how we get medical care. You are the former CEO of Illumina, and I think about DNA sequencing and all of the information and data that could potentially improve how we are treated when it comes to healthcare. How are you thinking about that space and what it might mean for Google Cloud and demand there?
Yeah, I think AI is going to have a very big impact in a number of ways across healthcare, right? So if we talked about some ways where it's helping in the delivery of care by freeing up medical professionals from administrative tasks and using more of their time to actually interact with patients. In addition, it's also helping medical professionals, get access to the information they need across a whole swath of information. So, they need to be able to stay on top of guidelines as they emerge, new research that's being published, as well as all the information on the patient. And increasingly, we're getting more and more personalized information on a patient. You talked about genomics. There are a lot of images, as well as previous lab tests. And so what AI can do is sort of take all that information and present it in a more digestible way so that you can make better decisions. In addition, AI can also help, earlier in the process of drug development. We've seen fantastic advances with tools like AlphaFold, which allows you to, deduce a 3D protein structure across hundreds of millions of protein types. What that does then is it allows you to identify maybe new druggable targets that allow you to treat diseases. AI can also help bring information together, the genomic information, the phenotypic information, the imaging information, and help us get better understanding of what causes diseases and how they develop. And that could give us new insights that allow us to think about how we can treat those diseases better. So in almost every part of the healthcare industry, you can see how AI can help improve that industry. We're
speaking with Francis D'Souza, Chief Operating Officer over at Google Cloud. Francis, I want to talk a little bit about competition. For years, Amazon has been number one. According to our Bloomberg intelligence team and data from IDC in 2023, AWS had about 47% of the infrastructure as a service market share. Microsoft in second place with 16%, and then Google coming in with about 6%. How do you get to number two and then number one?
What's really interesting is that as I talk to customers, what they're saying is there's a convergence of two really big important spaces. One is the cloud space, as you talked about, and two, AI. So nearly every customer conversation I have now and prospect conversation I have is really all about AI and how it'll impact businesses. And we are the only hyperscaler that actually has our own AI stack. So if you think about every part of the AI technology stack, Google has leading technology. So for example, on the chip side, we're one of the largest partners in the world with NVIDIA on GPUs, but we also have our own technology, TPUs, that are very highly performant, and we run them in our data centers. In terms of the models, we work with a number of other model providers. So if you go into our model garden, you can access models from companies like Anthropic and DeepSeek, but we also have the world's leading model with Gemini 2.5, which is performing really well on the top of the leaderboards in almost every part of AI. And so here, too, we provide our own leading technologies, and it's Gemini, but it's also our image models, our video models, our time series models, our weather models. And then we also provide our own applications on top of that, like Agent Space, that allow companies to easily develop their own agents. And then we have a leading cybersecurity portfolio. And so where we are differentiated in the market is that as we talk to customers, we're really the only hyperscaler that can talk about our own native AI stack that's leading technologies in each part of the stack, as well as our cloud. And that's playing really well. And that's driving a lot of the results that you're seeing, including the results we just published yesterday on the earnings call.
I got to say, it's the thinking models, the Gemini 2.5, that really kind of are blowing everybody's minds. Hey, one thing I want to ask you, speaking of customers, Tim and I, full disclosure, we talk about it a lot, are a little bit obsessed with Waymo. How much is Waymo using Google Cloud? I'm just curious in terms of keeping that all going and running.
Yeah, I totally understand why you love Waymo. I love Waymo too, living in San Francisco. I've been using it for a few years, and my daughters and I love it. As you can imagine, being sister, parts of Google, we leverage technologies that Google Cloud is building as well as DeepMind is building. And so as you could imagine, there's really close interactions from a technology perspective across these different parts of Google.
Hey, just 30 seconds left. Security. As we know, your former background, Symantec, you understand the importance of security specifically. And I'm just curious, what do you keep top of mind when you think about the security of Google Cloud and keeping it secure?
Yeah, as you point out, security is a really important area for us to focus on, and it's a core part of the value that we deliver to our customers in terms of providing a very resilient, protected cloud. There are a number of things that that are top of mind for us and for our customers as we talk about security, especially in a world of AI. One is it's important that security companies are leaning deep into leveraging AI to improve their security capabilities. So we offer agents, for example, that customers can deploy as part of their security operations center, as part of their threat intelligence gathering. And so we're also doing research on how AI can be leveraged by the bad actors, and think about how you can stay on top of providing defenses for things like, altered images and videos and deep fakes. It's also important to our customers that the security we provide works multi-cloud. So not just for Google Cloud, but that they can have the same security posture for workloads that they have on other clouds as well. And so that's an important part of the conversation too. So provide leading edge technologies, stay on top of AI and the expanding sort of threat landscape that opens up, and then also make sure that whatever you give us, works across clouds.
So glad we could get some time with you. Francis D'Souza, he's the Chief Operating Officer at Google Cloud, former CEO of Illumina, and also former president at Symantec, where he oversaw the security and data management portfolio.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.